Investors Chronicle.
Welcome to the Companies and Markets Show, the podcast that gives you expert analysis on all the latest market and listed company news. I'm your host, Dan Jones, and this is what you need to know. The results flood has slowed to a trickle, but there's still plenty of company activity for us to get our teeth into this week. And what's more, on today's show, we are looking at two of the lesser spotted UK IPOs of recent years. We will begin with PensionBee, which first listed back in 2021 and reported interim results this week. Mark Robinson will talk us through the pension consolidator's figures and new expansion plans. Later on, we'll look at that even rarer thing, a listing from the past 12 months in the form of sports supplement manufacturer Applied Nutrition. It IPO'd last October and announced a full-year trading update the other day. Valeria Martinez will discuss its prospects in due course. In between, our big read this week is all about leasehold properties, a magnet for bad publicity in recent years, but if you're buying a flat, the odds are you may have to deal with them yourself. Holly McKechnie discusses some of her 15 steps to protect yourself against an ownership nightmare. That's still to come, but we begin, as I say, with PensionBee. Mark, the half-year figures, let's have a quick recap overall. Well, before that, I should just say, if people don't know, given it's a relatively new public company, PensionBee, the idea is to consolidate users' pension pots into one convenient place. They attract assets that way. They've been relatively good at doing so. What did you make of the interim figures this time round?
I guess there was something of a dichotomy, really, because we saw a decent increase in revenues, which, given the fact the company has been operating for all that long, is to be expected in a sense. But we saw a pretty steep fall away in adjusted profitability. Actually, they're in loss on that basis. The overriding theme here, I think, is that this reflects what's going on in the US and the company's marketing push into the US. You saw there was a slight increase in cost linked to employee benefits and other miscellaneous expenses. That was slightly in advance of the revenue increase and all, but it's when you look at the advertising and marketing spend, that bumped up from about just under 6 million to 8.3 million. That represented a 42% increase. And a lot of that, again, is just focused on the expansion in the American market as well. So it just underlines the clear focus on where the company thinks that the main opportunity lies.
Indeed. We'll come to the US in a minute because that is the opportunity it sees, as you say. But let's talk about the UK for a moment. The company is founded just over a decade ago now. It's done pretty well at meeting its targets at which it set out at IPO in terms of the number of customers it wanted to acquire and breaking even in terms of profitability, certainly in the UK business. But in terms of the UK numbers themselves, how are they faring? Client numbers still rising at a decent rate, but acquisition costs increasing.
Yeah. The client numbers in the UK were up by 14%, and now it's got just under 300,000 members there. I mean, a lot of people look at this stock as well because it's one of the rare examples of a UK fintech which is sought to go on public markets. So I mean, it's probably watched by the wider market, apart from the people that actually bought into the company itself. Unfortunately, over the period, or unfortunately is probably the wrong word really, but it's sort of unit acquisition costs, the amount of money that it spends to get each new member on board, they increased by 4% to £251. Now that's just on the border of the threshold that PensionBee has set out, which is between 200 and 250 quid. But that has to take into account the fact that they've increased that marketing advertising spend so much during the period as well. So on that basis, it's pretty good. By definition, that should contract over time just due to economies of scale. But I think there's every chance that it's going to oscillate a bit in this point of the business's expansion too. So, it's an important metric, but we shouldn't ascribe too much, importance to it on that basis. A good point as well is that a brand, management made the point that brand awareness in the UK is getting up to very high levels, up to about 62%, something on that order, whereas it's in single figures in the US. So again, that explains where the marketing capital is likely to be focused. In fact, they made the point that the expenses themselves linked to US marketing weren't that extravagant in the first half of this year, but they're going to be raised dramatically through now to the end of the year and presumably into next year as well.
Yeah, in the UK, the thesis here is very much that people move jobs a lot more than they used to, and they have pension pots due to auto-enrollment at each one of these jobs. So over time, you can forget which pots you have and where they are and what's in them. So PensionBee will bring them together. That brand recognition is strong, as you say. It's the unprompted recognition figure is actually quite interesting too, i.e. not giving people who are surveyed an indication of the company. They were second only to Scottish Widows on that front, ahead of L&G and Aviva earlier this year, I believe, which is pretty good for a new business. Let's talk about the US, though, which we have been doing a little bit already. How are they marketing themselves there so far, and what's the latest on this expansion? What are they trying to do? This was funded by a placing last year the company had, saying it was looking to target the US market, which clearly is a big retirement savings market. But what did they say this time around about how things are going? It's still very early days.
Well, we should mention as well that the prize on offer there, obviously the job market over here is a little bit more fluid in terms of the related pensions. But in the US, there is the option there of rolling your old 401ks into PensionBee individual retirement accounts, and you can do this in a matter of minutes as well. So I mean that's a considerable sort of opportunity right there for the company. And again, that's the principal reason why they're focused on expansion of the year. Management referred to it as a foundational phase and getting away from the usual sort of corporate speak as well. That actually does make sense because they're putting in place infrastructure that will facilitate, the automated transfer of funds as well. They've also developed a self-employed offering, and more interactive tools on the app as well. So the market, actually development funds have gone in there probably ahead of the marketing push in a sense, really, but they have to have this in place. And of course, it's not just a case of duplicating the successful UK model. There's going to be slight sort of tailored differences to the US too. The management themselves said they're in a really good place now in terms of accelerating the operational growth through the marketing spend through the second half of this year. So I guess if at the moment they're sort of sprung, they're just ready to hit into that market. So I guess when the next time that we come to speak about the companies, we'll get a better idea. There's various difficulties in the US market compared to the UK, and there's a slightly different regulatory framework as well, and taxation that we probably touch upon in a moment as well. But that's it. I think the marketing push will really commence from now through to the end of the year and beyond.
As you'd expect nowadays, this is an omni-channel, I suppose, is what people would say, marketing push, or it seems to me at least, doesn't it? They have this partnership with State Street, which has contributed to, supported them for some time now, and they contribute some marketing ability, and they in fact covered some of the marketing costs in the first half. It looks like they've said there's going to be a multi-city brand campaign in the US too, and they're also talking about their presence on various social media channels and the growth in the number of followers, which I had a quick look this morning at all their accounts appear to still be growing, and that's the way to do things nowadays. Getting some campaigns on TikTok, they've spoken about things like that. You can do quite well with personal finance content on there. So that will clearly be reaching the kind of younger customer who, in the past, maybe it's not quite been younger customers, but they tend to focus on people with slightly smaller pots. So that's something they'll be working on too. I mean, the US, clearly it's a bigger asset opportunity. The people over there would tend to have higher value pots, but they will tend to be perhaps lower margin for the company. And also this expansion is going to go on, for some time. There's a big opportunity, but it'll take a long time to break the US, clearly. Could investors be forgiven for feeling slightly ruining it in some ways, given that the company's done very well at hitting its targets in terms of UK break even? They could have expected maybe once that point was reached, we might have seen a few years of real economies of scale and expansion in the UK and really hitting the bottom line, whereas now we're focused on a new expansion phase instead. I mean, I know that is, this is the nature of capitalism. This is the nature of a listed company. You've got to be looking out for the new opportunity. But I wonder if some shareholders might have thought they were looking for an inflection point in the UK, which may not come now because that money's being pushed into the US. I don't know.
Well, it's that's an age-old question, that one, isn't it? And I guess it rather depends on the rating that PensionBee was attracting anyway. I mean, if it's seen as a tech stock rather than a financial services one, people or some investors might be slightly disappointed on that angle. But Rome wasn't built in a day, and it does take time to build up that following. The relationship with State Street that you mentioned earlier is very important as well, because that not only reduces the sort of execution risk, for want of a better term, but it also provides a leg up in terms of that brand recognition over in the States too. I think if you look at the growth trajectory expectations from year 5 through to 10, well, the figure I saw that it was about a 20% annual growth, annualized growth in cash profits over that period too. So once we get over this initial hump, those cash profits, cash generation, and presumably shareholder funds will accelerate through that period. But this is true of just any investment, isn't it? I mean, anything under 5 years is a sort of speculation in a sense. It's a sort of a message that we sort of bang the drum a bit about at the Investors Chronicle. But some younger investors or green investors, they're impatient and they expect returns right off the bat. But you're better off taking a medium to long term view of the company.
Well, on that note, how does the valuation look? We should say that the chair has taken some money off the table recently at this point, but incorporating that, what's your view on the valuation of the company as a whole?
Yeah, I don't really have any comments. Mark Wood sold about 2,000 shares in the company the day after the results as well, but that's okay. Who knows the reasons there? Looking at the valuation, I had trouble with this when I was looking at the results initially, because obviously there's a certain blue sky element to this as well. So, but if you look at price to sales is sort of, and price to book are fairly slightly elevated actually compared to the rest of the market itself. So looking at the numbers themselves and bearing in mind that it's not profitable just yet because of that those monies going on advertising marketing. It's if I'm going to be perfectly honest about this, it's very difficult to come to a conclusion based on the numbers we've got through at the moment. So there is a certain, you're looking at the sort of narrative link to it rather than relative valuations. I know that sounds like a bit of a cop out on my part, but that's what that's the conclusion we came to.
Yeah, well, that probably explains why it's on a hold right now, doesn't it? And there is a degree of cyclicality to factor in to an extent as well, isn't there, in that it makes money off users' balances, takes a small fee as you'd expect, and that fee is calculated based on daily balances. So if you get a couple of bad months, you might have a bad quarter for the company, relatively speaking. Speaking of narratives, though, we should wrap up just by looking at some of the stories and the shifts playing out in the UK in particular. Clearly, there's been a lot of talk about changes to pension regulation, pensions coming into the IHT fold as well, which may not affect PensionBee specifically because its pots aren't really big enough for that to be a concern right now, albeit, who knows, maybe in 10, 20 years, if its users stay with it, that could be an issue. What do we sort of see about those? I mean, there is an argument that the higher profile nature of pensions, or the government's attempt to warn people that they're not saving enough for their retirement, should help a company like PensionBee as people think about these things a bit more and start wondering about their old pension pots, etc.
Well, there are other companies out there trying to address that market. The fact that very often when you come to the end of your working life, you'll find that you have sort of disparate pots lying here and there. I mean, that's it's been well known for a long time, but it can be problematic. I mean, you could draw it's analogous to the old share certificate regime as well. There was companies involved just in sweeping those up into the one place, if you like. I think one thing, if we look ahead as well, the point you made earlier, that you're always going to see a degree of volatility in terms of the size of the pots that are held in the account as well, because of the market changes too. People will get in and get out of markets fairly regularly. So we can say there's going to be volatility in that regard. The more interesting question is what differences the pension proposals will have. But they made the point that, like local government pension schemes, that's not a major source of flows for the company, and their consolidation isn't affecting its ability to attract new business. Changes to IHT as well could have some impact, but I think the general thought, and certainly in terms of research that I've looked at recently, is that, again, this is unlikely to have a marked effect on many of PensionBee's customers.
Yeah, indeed. Well, pensions legislation is, of course, always changing, so there may be further shifts coming down the line, and perhaps in the autumn budget too, but we will keep tabs on those and on PensionBee in future months. For now, though, we are going to turn to our big read of the week, all about leasehold properties, the problems with which, well, maybe they will need some introduction. You never know. There's been a lot of talk about some of the issues with the charges that one can find oneself wrapped up in with leaseholds, and there's been lots of reform attempts too, which we'll get to, Holly. But why don't we start by giving an overview of what we're looking at here and what we're trying to explain to readers as well.
Yeah, of course. So as you said, there's been a lot of terrible press for leaseholds in recent years, and there's been some real horror stories, and it would be very normal to feel a bit worried about those if you were thinking about purchasing a flat. And the reality is that a lot of us do either want or need to live in a flat, particularly if we live in a city. So there's not that many options out there other than buying a leasehold property. And then the question then becomes, how do you navigate that situation? Not all leaseholds are created equal. There are some properties that you wouldn't touch with a barge pole, but then there's equally lots of properties that are perfectly fine, and that you wouldn't have any issues either with buying them in the first place, living in them, or then when it comes to selling them, finding a new buyer. So really the piece is looking at how to sort of spot those issues, and equally what you can do if you find yourself in a situation where there is a problem with your flat and you need to resolve it.
Naturally, the best way to resolve or to avoid these issues is to make sure you're well prepared in advance when buying one of these properties, whether you're buying it for yourself or you're looking to do it for your children or you're looking to rent it out. Even the same principles apply. Can we talk about some of the basics about what you should do to begin with, and maybe what you should do differently or more rigorously than you would do with other properties? I mean, whenever you're buying a property, you want to be rigorous, of course, but there are certain things to look for.
Yeah, absolutely. So basically, the more due diligence you can do at the outset, the better. There are lots of factors that can cause issues, and there's no way to sort of go into all of them, and they can be very property specific. And I guess with a leasehold property that you've got the issue that the issues cannot just be to do with the fabric of the property itself. I mean, if you're buying a house, there could still be an issue with the roof that you need to replace, and that could be horrendously expensive, and you get the same with a block of flats. But you've also got potentially issues cropping up in the terms of the lease itself and clauses that you want to look out for, potentially avoid. I guess the good news is that sort of investigation skills don't all have to sit with you. Like, you will be employing a solicitor and a surveyor to look into those as well, and they'll be giving you a report. So yeah, very much scrutinise those reports when you do get them. Make sure you understand all the factors, and if anything crops up that you're not sure about, that's really the time to ask. Buying a property in the UK is incredibly expensive, and that's maybe an area that people sort of look to cut costs on, but that's probably not a good idea if you are buying a flat, just because, well, you might save a few £1,000s at the outset. If you then buy a property with one of these issues, it can be incredibly expensive to normally you can rectify the issues, but it could be thousands and thousands of pounds to do so. So yeah, it's not the answer anybody wants to hear, but sort of buy the best you can in terms of advice right at the beginning, and that can save you a lot of money in the long run. Outside of that sort of traditional investigation process that you will be doing with your solicitor and your surveyor, there are a couple of other things that you could do to have a look, get a better idea of the property. So one of those is just to actually try and speak to people who already live in the block. That might not be super easy. You might have to try and catch somebody as you're walking around when you're doing the property viewings, or like Facebook pages and things like that. But it's a really good idea to sort of hear about the lived experience in that property. What do they think about the management company? Because the management company might say, oh yeah, we come and do the garden, every month or so, or we're picking up the bins there, and you might actually find in reality that's not the case, and that's kind of giving you a bit of a red flag that maybe the building's not being very well managed, and whether or not they might be able to give you a bit of an idea if there's been any sort of ongoing disputes as well. You can formally ask about that in the sort of due diligence process, and that's definitely a good idea to do, but it's just another sort of way of looking at the building. If it's a leasehold, definitely try and do a bit of background on the freeholder. There's a ton of different sort of leaseholder advocacy groups out there who have written a lot about who the bad ones are. And again, like, some freeholders are okay and to stick with the law and do what they're meant to do, and then some are trying to make as much money out of you as possible. So that's something to consider. And then if there is a management company already set up, again, you can do a bit of due diligence on them. Also call them up, ask them any questions you have about the property. If they're a good management company and they think you're a serious buyer, I mean, they're not going to respond to every person who's got a passing interest in the property, but if they think you are seriously considering purchasing a flat in that apartment block, they should be happy to talk through any issues and concerns with you. And again, if they don't, then that's sort of a red flag to look out for.
Mm-hmm. Well, this brings us to the service charges, which are a high-profile issue. Or if something goes wrong, it's often relating to the service charge. As you note in the piece, they're not bad in and of themselves, because a property will need maintenance and you will need a fund to cover that. But that kind of points to another issue to look at, which is not just the starting level of these charges, but whether there is that sinking fund, that rainy day fund on hand as well, for a situation where you describe where there might be some issue coming down the line. And quite often a management company might know about something they're going to be paying for in the next couple of years, which you need to be aware of too.
Yeah, definitely. So the sinking fund is one of the most important things that you probably need to look at when you're looking at the property. So that would be a fund that everybody should hopefully regularly be paying into. That could be used to cover any sort of maintenance or repair costs, and they might be planned costs, or they might just be sort of ad hoc costs that sort of crop up when something goes wrong. Or again, we've had a lot of building safety regulations come through, which have then caused some properties to have extremely high service charges, and you've got a good sinking fund in, then that can help cover them. It can also be helpful in terms of if there's, because this is a collective endeavour, and if there's somebody in the property who maybe doesn't have the funds to, they don't have the money to cover those costs, then the sinking fund can be used to cover that, so you don't sort of end up in a situation where one person can't pay, there's just like water coming in through the roof for months or something like that. So that's definitely something to ask about. And it sort of, again, it comes back to sort of whether or not there's a good management company in place. So a good management company will have regular cycle of repairs going to make sure that, I guess, things don't escalate. So that's definitely something you can ask about. You can ask them about any major works, and that's also something that you should be able to tell from the survey, because if they come and say, okay, that roof looks a bit dodgy, I think it's going to need to be replaced in a year or two, then you'll have at least an idea that you've got a big bill coming your way. And it's then also something you could potentially negotiate with the seller, either to get some money off or to sort of hold some funds back, so that if that bill does come through, that could be used to go towards that.
Sure. And ground rent is the other big thing people think of when they think of problems. So what ways can people mitigate potential problems or guard against them emerging in future when it comes to ground rent?
Yeah, so the first thing is obviously you need to sort of check your lease and see what the ground rent clause are. There can be various different types of ground rent if it's a leasehold. The best one would be if it's a sort of peppercorn ground rent, and then you're just sort of paying a nominal amount to the freeholder to sort of satisfy the terms of it being a legal contract. The one that's causing a lot of issues at the moment is rising ground rent clauses, particularly in new build properties. There's been quite a few developers who have put some quite dodgy clauses in, basically where the ground rent payable to the freeholder sort of increases. Often it doubles over set periods, so they might be 5 or 10 years, and they can seem quite reasonable at the outset, but really escalate over the term of the lease, and then, you know, a lender won't touch that property essentially, which obviously makes it impossible for you to sell. First thing first, check that and probably avoid that property if it has that. But if you've already bought a property with rising ground rent, there are a couple of options. They are quite expensive to do. So one thing would be to extend the lease, because that sort of resets the ground rent back to the more reasonable levels. But I guess you're sort of facing that problem again in the future when ground rent will keep rising. And then sometimes people actually choose to collectively buy the freehold. So that's another option. But again, potentially more issues can crop up there, and it's very expensive. So best avoided if at all possible.
It's interesting you say that, because sometimes, certainly in contrast to leasehold, you hear of share of freehold being the solution. But there are, as you say there are issues, or there can be issues with that too, or certainly, again, things to watch out for, things to be aware of, whether you're buying a share of the freehold, whether you're creating a management company to look after these centralised costs too. There are issues which can arise here as well.
Yeah, it's definitely not a sort of golden solution, and it's maybe not quite what people always think it is from the outset. So it's I think maybe people think it's more like common hold, which I'm sure we can talk about later, where you own that sort of property outright. With a share of freehold, again, there are advantages. Like I said, it can remove the ground rent issue, can make the property more marketable because people hear leasehold and they panic. And it also gives you more control over the management decisions and costs. One thing to remember is that it still is essentially a leasehold property. There is still that underlying lease. It's just the fact that you also have a share in the freehold. And that can entail issues because it means you are collectively managing the building, and keeping on top of building safety regulations is really hard, especially sort of post-Grenfell. They're sort of constantly changing, and it's quite an onerous responsibility. Running a building in a sort of cost-effective manner is really difficult, especially if you're not necessarily got the sort of business background to do that, or you end up working with people who don't have that business background. So often, if it's a bigger block, it's sort of advisable to appoint a managing agent to help with that. But then again, you're employing somebody. There's all the things that come with that, and you've got to monitor them, review them, make sure that's working. And it means you have to get to know your neighbours quite well, and you potentially have to have some quite difficult conversations with them. Like, emotions will run high. Yes, you have to run it like a business, but it's people's homes at the end of the day. So, neighbours' disputes happen everywhere, but you're sort of increasing probably the likelihood of firstly them happening, and also the stakes if they do happen, because you've got to sort of work together towards a collective solution. And if you can't, you could go down sort of legal route, take them to court, but that's a whole another nightmare that you probably want to avoid. So yeah, I think you have to go into the situation knowing what you're taking on, that if you're going to become a director, you will have legal responsibilities under the Companies Act, and be prepared to potentially have some difficult conversations.
In the piece, we also talk about landlords and issues to watch out for there. We maybe won't go into those now, but they are all in the piece online and in print. But why don't we talk about some of the changes that may or may not be on the way? Because clearly with all this publicity, there has been a push to reform some of these issues, but equally inevitably, perhaps, the path towards that reform has not been smooth. There's been two bills and acts. There's the Leasehold and Freehold Reform Act 2024, and then in autumn this year is going to be the Leasehold and Commonhold Reform Bill. However, that doesn't necessarily mean that the changes proposed in them, which I'm sure you will go into shortly, it doesn't mean that they are going to be on the way or necessarily effective. Is that fair to say?
Yes. So I guess to start with the Leasehold and Freehold Reform Act, so that was granted royal assent in May, and that proposed a number of changes to sort of strengthen leaseholders' rights. So, for example, it should hopefully make it easier and cheaper to extend those shorter leases and give you an opportunity to... Often, historically, leases have been about 125 years in length, where this will make it much easier to get a 990-year lease, which, you don't have to worry about the lease running out if that's the case. The problem is a group of freeholders have brought a judicial review challenging the components of the Act, and we are still waiting judgment for that. Hopefully, in the next month or so, we should hear back on that. I think the general legal consensus is that the freeholders' case isn't particularly strong, but the freeholders have an awful lot of money. They've got deep pockets, and in all likelihood, if it doesn't go their way, they will appeal that case. So that leaves leaseholders in sort of in limbo, again, and it could be sort of months and months before there's any resolution on that. And even once it goes through, there could still be secondary legislation to be introduced to implement some of those aspects of the Act. So in principle, great, and those things should be really helpful for leaseholders, but it could be a while yet, and incredibly frustrating if you are in a property and you need to maybe get a lease extension. It's going to be much, you're running out of time and you're suddenly going to have to spend a lot of money where there is legislation on the horizon that could make that a lot cheaper. And then on the sort of the Commonhold Reform Bill, this is expected to basically introduce a new framework for how Commonhold would work. It is an existing type of tenure and has been around since 1995, but it's just never really taken off. There's, I think, probably less than 200 properties registered with the Land Registry with that kind of tenure, so the likelihood of you coming across it is vanishingly rare. And because it's so uncommon, a lot of mortgage lenders are a bit nervous about it anyway, so it doesn't really resolve that issue. So we'll have to see what exactly sort of is in the bill and how it will be implemented, but I think there is a lot of sort of scepticism from industry experts that this will prompt the changes that people are potentially hoping for. It doesn't also sort of get rid of the issue of you starting to collectively looking after a building with other people, which always runs into issues, and it won't get rid of the need to have service charges in some form because, again, buildings still need to be maintained. And then potentially another issue that people have sort of raised is that we're going to have to find a way to convert those existing leaseholds into commonholds, so we don't end up with a sort of people having stranded assets that they can't sell because they've become the sort of minority that people don't want.
Well, this article, this feature is very much about trying to avoid landing people with a situation where they have an asset they don't want, trying to resolve the situation. So we've spoken about a lot of issues that can come up and a lot of ways to improve them. And I think the focus is very much on the latter, isn't it? It's not, even the phrase, it's not necessarily a disaster. It sounds very bad, but it's very much about a situation which doesn't have to be as bad as it is made out, I think is the way we're portraying it. And I think that's fair enough, because despite all the bad publicity, there are a vast number of people living in these properties and doing so perfectly reasonably and without due qualms or anything like that. So Just tried to add in a corrective there at the end for people who've been thoroughly scared away, because there are ways you can mitigate these issues, and that is all detailed in the article, which is in print this week and online as well, of course. To wrap up, though, we are going to talk about another company that listed very recently, in this case, Applied Nutrition. Valeria, why don't we start by talking about what the company does exactly. As I said at the top, it is a sports supplement manufacturer. It makes a lot of protein and workout-based products. But can we say a little bit more about what those products are, what the geographical business split of the company is, and then we'll go into the latest figures.
Yeah, I mean, as you say, its sort of main product is protein powders and pre-workout supplements. It sells this through 4 different ranges, and it's been expanding into other things like creatine, and then a fast-growing part of the portfolio is also these things called grab and go, which you'd think of sort of, protein drinks on the go, or even, cookies with protein and that sort of thing. So that's been kind of a newer thing in the portfolio. But the interesting thing about the company is how it sells these products. Obviously, THG with My Protein, listeners might know that company, but they focus much more on, selling directly to consumers, whereas Applied Nutrition has a model where 91% of revenue actually comes from business-to-business sales. So that's, retailers in the UK like Tesco, Asda, Holland & Barrett. They also sell to gyms directly. And then another big part of the distribution model is to sell to international distributors, which is the way they've been able to sell to more than 85 countries. So they also do sell to consumers directly, but that's just 9% of the business. And that's mostly through, third-party e-commerce platforms like Amazon, eBay, and then it's its own website. A smaller part of the business as well is kind of their white label business, but as they've been sort of trying to increase brand awareness, that's not really the focus anymore. And then, geographically, as I said, 85 different countries. The UK is still sort of its core, but actually international sales make up a much bigger part of the business now. That's mainly in the Middle East and North America. It also sells into Europe, but that's still a small proportion of sales, and that's still mainly through distributors.
Yeah, that is the interesting part of the company, that distribution model. I mean, clearly this whole market has been rapidly growing for some time now. Wellness, but also workout, exercise, that kind of thing. These trends are very much embedded in society at this point. So how is that converting into trading at the moment, all of these things? As I say, it was a full year trading update, so figures for 12 months, looking like the second half of that period was particularly strong for the company.
Yes, and that's exactly what management promised a few months ago, that the second half will be stronger, and that's been the case. Trading has definitely picked up. The company expects revenue of around 107 million. That's well ahead of the 100 million that analysts were forecasting. That's mainly driven through the second half of the year. There's a few drivers for that. There's been product launches that have landed well. There's been new listings in the US, also starting to gain traction in Canada, Latin America as well. A big part of the difference is also that issues that had been taking place in the Middle East have now sort of been lapped, or resolved. And then in the UK, the partnership with Holland & Barrett is also adding to momentum. And they've also been able to, push through price increases on whey products as well. So that's sort of been contributing. And Peel Hunt now expects about 7% revenue growth annually. And then earnings per share rising about 10%. So momentum has clearly improved. The upgrades have finally come. The momentum is definitely on the company side at the moment.
They are back at their IPO price, which is kind of par for the course nowadays, isn't it? That you IPO at a high price and then some of the momentum subsides and people get left holding the bag for a brief period. But it's not been too long since the IPO, so to be back at this price is credible enough, and they'll be hoping clearly to make some gains from here. However, there are some potential headwinds for the company. Margin pressure is something analysts have been worried about because partly due to its distribution model, it does have very high margins at the moment, albeit they have been coming down a little bit and might be expected to come down a little more clearly given the interest in this sector, it is a very competitive area and there are questions over pricing too and things like that.
Yeah, I mean, essentially what analysts were saying is that these margins are too good to be true, essentially, and they were questions about whether they would be sustainable. Peel Hunt, they were saying that marketing costs were really low, but that they would actually need to be increased as the business grows. Also, wages, they said that obviously, again, as the business grows, they would probably have to pay more of those. And there's also higher costs from being a listed business. And then, as you mentioned, just higher input costs on whey. So margins are expected to fall from 30.2% last year to 28.9% this year for the reasons that I mentioned. There's also, when deals with big retailers like Walmart might dilute margins as well slightly, but that's also going to be positive for revenue. So overall, it might be more of a net gain. But I think margin pressure is a story that investors are quite familiar with, and that it's an expectation. Gross margins at the moment are nearly 50%. That seems high, and for a larger business, that's probably not sustainable.
Well, like PensionBee, a completely different company in many other ways, they are looking at US expansion, and also their marketing takes on the multi-channel approach, doesn't it? There's the distributor partnership with Walmart and companies like that. They do have a partnership already, and also they partner with various athletes and football clubs and sports clubs, things like that. If you look on their website, there appear to be a lot of north of England clubs like Preston North End and a few other championship and league clubs like that. So clearly they provide their products to these clubs, these businesses. They're going to provide the players with the nutritional products they need. Equally, they might be looking at, influencers, things like that, to promote the company a bit more in the US, all of which is a roundabout way of saying what are the US plans and how are they potentially planning to expand in the US? What are their goals there?
Yeah, I mean, that's one of their sort of main, growth ambitions. They seem to be pretty serious about it if you look at, the team. So they launched in the US in January 2023, and the US team already has 14 staff, which is, if you compare it to the 48 in the UK and other global offices, that seems like a lot and potentially a signal of the impetus there. So there's clear ambition to scale. Again, it would follow a similar model that has worked, elsewhere, focusing on shelf space and partnerships rather than trying to blitz the market with online ads, as you might see with other companies such as MyProtein. Walmart is one of their partnerships there. In the second half, they also secured a couple more listings with some large US retailers as well that might not be as well known to us. There's one called General Nutrition Centers, and then another one in the Midwest and another one in Texas. They're securing new listings. The only thing, of course, is the US market, especially the US supplements market, is quite saturated. So that sort of ties back into what I said earlier about having to increase marketing spend because there's a lot of competition.
And to go back to your other point, I mean, given, I suppose, the lack of D2C selling right now, the easy win of marketing on social media and influencer, that kind of thing, isn't such a big deal for them because they do need to, as you say, get this shelf space, get the deals with retailers and distributors, which is very much more of a hard-nosed type of fare. We should maybe touch very briefly on tariffs when we're talking about US expansion of physical products, albeit the news here is relatively positive because they don't think they'll be affected particularly. Clearly, the UK tariff is only 10% anyway, but they don't think it's going to be that big a deal for them.
No, obviously analysts grilled the management about this. Unsurprisingly, in April, they said that tariffs won't really affect the business. That's mainly because its liquid products are already outsourced in the UK. So CEO Stephen Granite said that they were considering moving production to the US if needed, but that would be sort of price neutral based on conversations that they've been having. So yeah, from a cost perspective, shouldn't really create a bit of a big drag, but obviously that will take some operational work to pull off.
Indeed. Well, they're only 9 months or so into their public life, so clearly very early days. But as with PensionBee, US expansion is on the cards. That's their goal, and we'll be checking in with them again in the months and years to come. For today, though, we have run out of time. So thank you very much to Valeria, to Holly, to Mark, and thank you to you for listening. We'll be back next week with another Companies and Markets show.